Hey everyone, this is Yossi. I run an investment firm that specializes in REIT investing, and today's video I'm gonna highlight 3 REITs that I probably wouldn't buy. I would probably sell them if I own them today. Make sure to stick till the end of this video because you don't want to miss any of these. I think that the risk to reward of this REIT is very questionable. And before I get into it, if you could still also like this video, it will help me a lot. Thank you very much. So the first REIT that I would probably sell is called Iron Mountain. Its ticker symbol is IRM. This is a REIT that invests mainly in paper storage facilities. It's also investing in growing its portfolio of data centers, and lately its market sentiment has greatly improved, mainly because of this pipeline of data center development opportunities, and so now it trades at a historically high valuation of around 20 times FFO. And I think that here the market is getting a bit ahead of itself because yes, its pipeline of development opportunities in the data center segment is quite attractive, but what the market here seems to be forgetting is that the company is still mainly invested in paper storage facilities. And while I don't expect paper storage to go anywhere anytime soon, I think that there is a high risk that the same property growth eventually turns negative. And even if it turns just slightly negative, let's say 1% negative growth rate, I think that this could very negatively affect the market sentiment of the company because, you know, the market is a forward-looking machine and it's very quick to extrapolate recent trends far into the future. Today, the same property growth of its paper storage business is slightly positive, and so the market is not worried about it. But if we now suddenly have even just a slight decline in organic growth in this segment, the market is going to price that far into the future, and that's going to, I think, cause its valuation multiple to compress quite a bit. Historically, this company has traded at closer to 10 to 12 times FFO, and I like the risk to reward at that valuation, but priced at 20 times, I think the market is getting ahead of itself. So the second REIT that I would probably sell is called Universal Health Realty Income. Ticker symbol is UHT. This is a fairly low quality REIT. It's a small cap, it's externally managed, it has a fair bit of leverage. Its properties are not bad per se, but it's the lower quality end of medical office buildings. There are conflicts of interest between the manager and the shareholders. They recently had one big property go completely vacant. And despite all of that, this company actually performed relatively well compared to most other REITs in 2022, and as a result now its valuation is higher than that of some of its higher quality peers like Healthcare Realty, which is fairly similar REIT, but it's internally managed, it has better quality properties, it has better long-term growth prospects, a bit less leverage, a better management team in my opinion. And so now you have an opportunity to essentially sell UHT to redeploy the proceeds into a higher quality REIT in the same property sector, ticker symbol HR. I'll put a table in the screen that will show you the difference in valuation. It's not big, but you know, you're not paying a premium to get this higher quality REIT, and so why would you own UHT? Then the third REIT that I would probably sell is called Public Storage. Its ticker symbol is PSA. The company made a lot of headlines recently as it hiked its dividend by 50%. That's an unusually high dividend hike, and it caused its share price to surge a bit, but I think that's actually a red flag. I think that it implies that the company is now having more difficulties reinvesting its cash flow in future development projects, and so instead of that, it's now deciding to pay out a larger portion of its cash flow in dividends. And this is not really surprising. You know, there's a huge amount of supply of storage already in the US. We have, I think, around 10 times the amount of square foot per capita in the US as compared to the UK as an example. And so most development projects have now been already completed. There's new facilities, it seems like, in every busy intersections of the country. And meanwhile, I fear that a lot of the recent demand that originated from the pandemic probably won't last for much longer. The pandemic caused a surge in demand because suddenly a lot of people were moving from a city to another. People were also making space for home office, and so they needed some extra space to store their stuff. A lot of the older generations also passed away because of the disease, and so they left a lot of stuff behind. But as things now return to normal, I think that increasingly many people will stop moving around as much. People will also perhaps return to the office, not needing the home office as much. And the vaccine obviously also has helped a lot to reduce the amount of people dying from COVID. And so I fear that the earnings of public storage and other storage REITs might not be sustainable. They grew very significantly in 2021, 2022, but if now market conditions normalize, we could see a dip in demand, but there is a lot of new supply that hit the market recently, and so the occupancy rates, the rental rates might drop quite a bit. Yet the company is today priced for the growth to continue. It's priced around 20 times FFO, which is definitely not on the low side for REITs that are potentially facing negative organic growth going forward. And for this reason, I wouldn't be interested in owning this REIT. I would probably sell it if I owned it. I think that in this property sector, there are much better opportunities on the other side of the Atlantic in Europe. You have REITs like Big Yellow Group, ticker symbol BYG, that are trading at comparable valuations, but I think that these European REITs have much better growth prospects going forward because storage as a concept is still relatively new in Europe. It's growing in popularity and there's still not much supply. The supply is 10 or 20 times lower than in the US, and so these REITs now have a long runway of growth ahead of themselves as they develop more space. And so these are 3 REITs that I personally wouldn't buy. I'll put a link in the screen if you want to now watch a video of other REITs that I would be buying instead of these. Also, if you want to get access to my entire REIT portfolio, feel free to join my REIT newsletter for a 2-week free trial. I put a link in the description. And finally, again, if you could like this video, it will help me a lot. Thank you very much.